right, welcome back to my presentation. I'm Dr. Sharma again. I'm going over the recording of transaction. This is the second part of the transaction recording video, and in this, I'm going to talk about the double entry system of accounting and journalizing of the transactions. So, of course, now henceforth, whenever I'm referring to transaction, I'm talking of both the transactions as well as the events having the financial implications. Many authors differentiate the transaction events by saying external transactions are those that have an exchange value between two or more parties, and events that I have been referring to as internal transactions. So just to capture both of those, we'll be talking about them combinedly as the transaction. So that's what we're going to talk in this video. Now, as you know, all business use the double entry accounting system. Now, what is a double entry accounting system? Basically, double entry system of accounting is that every transaction will entail a twofold effect, because the basic tenets of life is that if somebody gives, somebody receives it. So based on that give and take philosophy, we will be using that concept to implement it in accounting. So that's the double entry system. In a typical business, the resources owned are called assets, and the claims of various parties against these assets are called equities. Now, that equity could be a claim against the assets by the outside parties, that is, people who have given you the money, or it could be by the owner. So that is what you have to understand about that concept. Now, according to this duality concept, double entry system of accounting, total assets must always be equal to the claims to those assets. So therefore, our accounting equation is based on that philosophy. Assets will always be equal to the equities. Now, as I said to you, this equity can be owner's equity, or it could be outsider's equity. Now, owner, of course, for accounting purposes, is also treated as separate from the business. But here, when we're talking of outsiders, that means if you have borrowed money, somebody has given you services on credit, all that will be part of that claim against the resources of the company in terms of the lending. So therefore, we come to the accounting equation as assets will be equal to the owner's equity plus the outsider's equity. So that's how double entry system works. Now, as you can see, we have been talking about this double entry system of accounting in terms of equation. So assets, liabilities, and owner's equity are basically the three pillars of present day accounting. The association they share can be expressed using the balance sheet equation known as asset is equal to equity plus the liability. So asset will be equal to equity plus the liability. Now, as the company grows, what will happen is the company will start earning income. So therefore, it could be considered as asset is equal to equity plus income plus the liability. So now, what is income? Income is revenue minus expense. So as the business grows, the company will be earning income. So therefore, your new accounting equation will be asset equal to equity plus revenue minus expense plus the liability. Now that is going to be the accounting equation. Now, as you make income, as the business earns revenue and it spends money on expenses, it will also start distributing that earnings to the owners. That is known as the dividend. So therefore you will have asset is equal to equity plus revenue minus expense plus liability minus the dividend. Why minus dividend? Of course, we are distributing out that money, so the resources of the company goes out. So now, considering this accounting equation, what we can do is we can express this as asset plus the expense. I'm bringing this minus here, plus the dividend, that also I'm bringing this side. We'll be left with equity plus revenue plus the liability. So that is your final accounting equation. So based on that equation, we will be learning how to account for different transactions. So now again, we started with assets. These are the resources, and the equities. Equities are the claims to those resources. The claims can be made by the owner or an outside party. Now, that outside party, we call it as a liability. The inside of the owner's claim against the resources is a equity. So then what we call expand that, because as the business grows, as you do business, the company will be making income. Now, if it does not make income, then of course your existence is at stake. So if you start making income, income is of course a difference between the revenue and expenses. So then we manipulate that accounting equation, and finally we get this accounting equation. So that is how we handle this segment of the accounting equation. Now, based on this, we are going to go over and study the rules of debit and credit. So let's just take the rules of debits and credit based on that expanded accounting equation. Now, as you can see, the rules of debit and credit for the assets, because remember the expanded accounting equation was asset plus expense plus dividend will be equal to, of course, the owner's equity plus the liability plus the revenue. So that was the final accounting equation we did. So the rules of debit and credit for this part is going to be same, and very fact, the mathematical equation, the other part is going to be the opposite of the first part. So that is why after the equation sign, this will follow a rule which is opposite of the left hand side. So first we are talking of the left hand side. This is rules for assets, expenses and dividend. Now what we try to do is, whenever there is a transaction, we try to find out whether it is an asset, expense or dividend is involved or not. If it relates to the asset, expenses and dividends, will determine whether the asset will increase or decrease. So does it increase or decrease? That's the logic we will be looking for. So if it increases, then you will be debiting it. So this will be a debit. Okay, so this will be a debit. Increase is a debit, and of course decrease is a credit. So that's the rule of debit and credit for assets, expenses and dividend. As I said to you, when we go to the other side, that is the liabilities, equity and the revenue, the rules are going to be exactly the opposite of this. So that means, again, what we are going to do is we are going to find out whether there is an increase or decrease in these items. So whether the equity is increasing, liability is increasing, or revenue is increasing or not, or is it decreasing? So any of them increase or decrease. Now when it comes to the rule, it is going to be the opposite. Increase on the left hand side was a debit. Now increase on the right hand side will be a credit, because it has to be opposite. And then again the decrease will be a debit. Okay, so that is the rule of debit and credit. So on the left hand side you had asset, expenses, and dividend. On the right hand side we had equity, liability, and the revenue. Now of course this dividend also could be a drawings if it is a sole proprietorship. If drawing would be the withdrawal, if the sole proprietor or the partners withdraw some money out of it, the same rules will apply. So that is your rule of debit and credit. Now you can see the summary in short. The expenses, assets, dividend, or drawings will be debited if they increase and will be credited if they decrease. And the opposite happens if there is an increase in the liability, owner's equity, or the revenue, that will be a credit, and decrease will be a debit. And whenever you are implementing this rule of debit and credit, you should always think in terms of the business. For the business, is the asset increasing or decreasing? Okay, that's how we'll be implementing the rule of debit and credit. Now, if you just take the sample transaction, if you look at the transactions that are given to you, and let's implement the rule of debit and credit. Now it says investment by owner. Number one, the transaction is that the owner started business with cash. So owner started business with cash. First, you have to understand that cash is involved. And the owner, now owner's account is always represented by either a common stock or a capital. In this case, we are not told that it is a company or a corporation. They just said started a business. We are going to presume it is a sole proprietorship. Therefore, we'll take this as a capital. So these are the two accounts involved. Now, what is cash? Cash is, of course, asset. What is capital? Of course, it is a owner's equity. So now if it is an asset and if it is an owner's equity, now the point is it increasing or decreasing? Now the business is getting the cash, so therefore the cash is increasing for the business, and capital was zero because we did not have any business so far, and now it has increased with the amount of investment, so that is also a increase. Now sometimes people get confused with that. Now capital, there was no capital at all. It's a new business. So supposing the owner brings $10,000 as a capital, cash will increase by 10,000 and the capital also will increase by 10,000. So that is what you have to understand about it. Now remember the rule of debit and credit. We had a rule which said asset plus expense plus dividend. If it is an increase, we'll debit it, and if it is a decrease, we'll credit it. That was the rule. So now in this case, cash is an asset and it is increased, so therefore I am going to debit the cash. So that is what you have to understand about it. Capital, of course, is the owner's equity. When it increases, of course, remember your equity plus liability plus revenue share the same rule. Increase is credit and decrease is a debit. So this is the rule that will be applying. So in this case, it will be a credit. So that's your investment by owner, transaction number one. Next is purchase equipment for cash. Okay, now what are the two things that are happening? I'm buying equipment, so I'm going to consider that as equipment account. And then cash, of course, I'm paying cash. Now, equipment is an asset, cash is also an asset. What's happening to equipment? You're right, it is increasing. Now, what is happening to cash? Of course, it is decreasing. So, now what we do is we apply the rule of debit and credit. Asset, when they increase, we debit them. When an asset decreases, we credit them. So that is why we'll be debiting equipment and crediting cash. So that is how this will be taken care of. Now the next thing is the purchase inventory for cash. So whenever you are purchasing inventory, of course, inventory is an asset. So let's write it down again. Start with inventory, of course, and we purchase that inventory for cash. Inventory is an asset, cash is also an asset. When I buy inventory, the stock of inventory in my business will increase. So this will increase. But when I paid cash, my cash balance decreased. So that's why this is a decrease. And now again, go back to the rule. If an asset increases, it will be a debit. So this is going to be a debit. And if it decreases, it's going to be a credit. So that's how we'll be handling these sample transactions. Okay, let's move on with our journalizing of transactions. Now you can try some of these transactions. Purchase inventory on account. Again, what are the two accounts involved in this? Of course, inventory, because I am purchasing the inventory. So if I purchase inventory, I'm going to use that as a asset. So let me write that down as well. So first is I'm purchasing inventory. So that's one account, inventory. What is the other account? It says purchase on account. Whenever you hear that word on account, you should always keep in mind it has to be either accounts payable or accounts receivable. If you are going to receive the money, that's going to be accounts receivable. But if you're going to pay the money, it's going to be accounts payable. Now, in this case, think for a while. You bought inventory, so you're going to pay to that person. So therefore, it has to be accounts payable. So accounts payable. Okay, now one is an asset and accounts payable is a claim of your creditor against your assets. Therefore, it is going to be a liability. So, inventory is an asset. It is increasing because I just purchased that. So, this is an increase. And when an asset increases, what you are going to do? You're going to debit it. And whenever a liability is incurred, remember now, don't get confused again, I'm incurring this liability. There was no liability so far, it was zero, now it is increasing with the amount that I need to pay. So this is again an increase, and therefore it is going to be a credit. Why? Because if it is a liability, if it increases, we credit it. Next, sold inventory for cash. Again, the what we call accounts are inventory and cash. Okay, inventory is an asset, cash is also an asset. I'm selling the inventory, therefore the balance is decreasing, right? Here in this case, what is happening is when I'm selling the inventory, I'm not using the inventory account. Why? Is because we will have to track what is the amount of sales I have made. So that is why instead of inventory, using the inventory account, I'm going to use the account known as the sales revenue. So when I purchase the inventory, I put that in the inventory account. When I'm selling it, I'm going to use the sales revenue account. Again, of course, I'm going to track that inventory and transfer it to cost of goods sold. So that is something that we'll be talking in a later chapter. For now, whenever I'm selling the inventory, of course, I'm going to consider that as a sales revenue. Now, I have not made any sales so far, so therefore the revenue is increasing. And what is happening to cash? Cash is also increasing. So that's why I have a cash increase and sales revenue increase. When a revenue increases, I credit it. And when a cash increases, I debit it. So that's how you're going to handle this. Next is the paid for rent expense. I paid for rent. So if I pay for rent expense, now what are the two accounts? As soon as you hear that word paid, it means cash. So one is your rent expense, another is your cash. Now, rent expense is an expense account and cash is an asset account. I have just incurred the rent, so therefore my rent will increase because I did not have a rent account so far. Now, cash will decrease because I'm paying out cash. So that will be an increase and as well as a decrease in cash. So increase in rent expense and decrease in cash. When expense increases, I debit it, and when my cash decreases, I credit it, following the rules of debit and credit. Now, that is how we will handle this increase or decreases in accounts. Now let's just take a demo problem. The following transactions relate to Charles, a sole proprietor. Charles invested cash in a sole proprietorship. A piece of land was purchased, 50% was paid as down payment, and for the rest in note was signed. Purchase of inventory from Celia. Sales made to customers for cash. A building was purchased for cash. Insurance premium for 12-month policy was paid in cash. And then paid office secretary salary for the month. The amount owed on the land was paid. So now what you need to understand is we'll have to apply the rule of debit and credit using our accounting equation as the basis. So the requirement is identify the increase or decrease in the elements of accounting equation so that the rules of debit and credit can be applied using upward arrow for increase and a downward arrow for a decrease. Also write the accounts involved. So that is what we are asked to do. So this is the demonstration problem number 1. So let us take that problem one by one. Okay, first is Charles invested cash in a sole proprietorship. So that's number 1, cash and of course capital. Why? Because this is a sole proprietorship, so therefore I'm going to use that as a capital. Now, since Charles has invested cash, cash has increased. And what has happened to capital? Also increased. Now, apply the rule of debit and credit. Now, remember the rule of debit and credit is asset plus expense plus dividend is one set equal to liability plus owner's equity plus revenue is another set. Increase in this is debit, decrease is credit, and other way around, increase is credit and decrease is a debit. Okay, so cash is increased, so therefore using this rule I'm going to debit it, and capital is increasing owner's equity. So using this rule, I'm going to credit it now with the amount of money that has been invested. Now, number 2 is a piece of land was purchased. So land is number 1. 50% paid as down payment. So that means whenever you hear that word cash, and then for the rest, a note was signed. So notes payable is another account that I'm going to use. So these are the 3 accounts that I'm going to have. So this is going to be called as a compound journal entry. Whenever a transaction has more than one debit or credit, we call that as a compound journal. So this is what is going to happen. Okay, so first let's find out. Land. What kind of account is this? Of course, this is an asset. Cash, asset. Notes payable, liability. And what is happening to land? I'm getting that land, so therefore it is increasing. What is happening to cash? It is decreasing. And what is happening to notes payable? It is also increasing. Okay, why? Because there was no notes payable so far. From 0 to whatever amount was the land, 50% will be increasing. So now asset is increasing, therefore it is a debit. Cash, asset is decreasing, therefore it is a credit. Notes payable is increasing, therefore it is a credit, following that rule of debit and credit. So that's number 2. Number 3, purchase of inventory from Celia. So now what you have to understand is purchase of inventory from Celia. So one is your inventory, and Celia is now, what we have to do is, remember in the last video I talked about a general account and a subsidiary account. Now we are dealing with the general account, so we're not going to go with the subsidiary part. So therefore what I'm going to do is I'm purchasing the inventory from Celia, and it does not say that I paid cash for it. So therefore I'm going to consider that as accounts payable. Accounts payable, inventory is an asset going up, accounts payable is a liability going up, therefore it is a debit and it is a credit. So that's how we'll handle number 3. Number 4, sales made to the customers for cash. So here it is specifically given that I sold, therefore this is cash and a sales revenue. So now what is happening is I have made a sales to the customers for cash. Cash is an asset, and revenue, of course, sales revenue is a revenue. Cash is increasing because I'm receiving it, and sales revenue is also increasing it. Cash is an asset, increasing, debit. Sales revenue is a revenue, increasing, credit. So that's how we get that what I call increase and decrease, as well as a debit and a credit. So that is your number 4. Let's go on to number 5. Okay, number 5 is, of course, a building was purchased for cash. So number 5 is your building and cash. Now what kind of account is a building? Of course it is an asset. What kind of account is cash? Of course it is an asset as well. I'm buying building, so therefore it is increasing. And cash, what is happening to cash? Of course it is decreasing. Now if you apply the rule of debit and credit, increase in asset is a debit. So I'm going to write debit here. Decrease in asset is again a credit. So I'm going to write that as credit. So that's number 5. Number 6 is insurance premium for a 12-month policy was paid in cash in advance. Now I'm paying the insurance premium in advance. So what I will do is I will use an account known as prepaid insurance, and I paid cash. Now, prepaid insurance gives you the right to use that insurance policy for a future period. Therefore, it is an asset because it's going to give you a benefit in the future. So I'm going to consider this as an asset. I didn't have any prepaid insurance, so it is increasing. Cash, of course, is an asset and it is decreasing. Apply the rule. Increase is debit. Decrease in cash is a credit. So I'm going to credit that cash for number 6. Number 7 is pay the office secretary's salary for the month. So for the month you are paying the office secretary's salary. So therefore it is going to be a salaries expense, and you have paid it, so therefore it is going to be cash. So these are the two accounts. Expense is of course an expense account, increasing. Cash is an asset, decreasing because I'm paying that out. Now expense, when they increase, it will be a debit, and cash, when it decreases, it will be a credit. So that is how we handle number 7. Number 8 and the last is the amount owed on the land was paid. Remember, we had signed a note in number 2 transaction. So now I'm paying out of that. So that is why I'll be using the notes payable account, not the land account. Please remember, land account was debited and we are done with it. Now what I'm doing is I'm paying on the amount of money I owed. So that is why I have to use the notes payable and cash. Now notes payable is a liability. It is decreasing because I'm paying it. And cash is an asset. It is also decreasing. So if a liability decreases, what do? Debit. When an asset decreases, what do? It is a credit. Now you must have noticed in all these things that we have done so far, if one account is debit, the other account will be credit automatically, because the debit and the credit have to be equal in the double entry system of accounting. So that is demo number 1. Now demo number 2 is, as you can see, what we are given is we are given an accounting equation, and then what we are asked to do is give the possible reasons for each transaction. So now let's just see the first transaction. What is happening in the first transaction? Cash is plus and capital is also plus. So what does that mean? It would mean there is an increase in capital. So that is number 1. So cash was contributed by the owner. So therefore possibly the reason will be the owner invested cash in the business. So that would be 20,000. So that's how I will handle number 1. So cash invested by the owner, 20,000. Number 2, I see a minus in cash. So that means I have paid out cash. And I see a plus in the equipment. So what does it mean? Equipment is going up. So I put equipment by paying cash because the cash is going down. So that's number 2. Number 3, I see supplies account is increasing and accounts payable is increasing. Now, why do you think supplies will increase? I would have purchased supplies. So purchase supplies because my accounts payable is also increasing. I would think that I purchased the supplies on account. So that would be number 3. Number 4 is I see an increase in cash and an increase in the revenue. So that would mean I provided some service and I got a revenue. So I would say the revenue received in cash would be number 4. Number 5, as you can see, what has happened is cash is increasing by 1,000, accounts receivable is increasing by 1,500, and the revenue is increasing by 2,500. So I would think the revenue is earned 2,500. Out of the 2,500, I receive 1,000 in cash, and 1,500 is receivable that will be received in the future. So that would be number 5. Number 6, you can see minus 750 and minus 750 in what I call cash. So if you see a minus in cash, that would mean the cash is decreasing. And why it is decreasing? Because I paid off some accounts payable. So accounts payable was paid in cash. Next is number 7. I received cash 500 because cash is plus, minus receivable. So that would mean I would have received $500 from my customers who owed me some money. So that is going to be 7. And 8, of course, will be I had supply decline. So decrease in supply means it is a supplies used. Now that's an important concept, so let me just explain that. So whenever we use the supplies, so supplies is an asset, and when we use the supply, it becomes an expense. Please remember that fact. Until it is used, it is an asset, but once it is used, it is an expense. So that is why you can see supplies is reduced by 400, but out here there is an expense of 400. So in the last column, plus is revenue, minus is an expense. So that's why we see we have transferred our supplies account to the expense account. And the last one is cash is paid 2,000 and it would have been paid for some expense. So those are your possible reasons. So you can see number 1, investment of cash in business by the owner. Number 2, purchase equipment for cash. Number 3, purchased supplies on credit, earned revenue in cash. And you saw in number 5, there were 2 items, 1,000 and 1,500. So that 1,000 was earned in cash and is earned in credit. Paid accounts payable, received cash for and accounts receivable, used supplies in business, and paid expense of business. So that is, of course, how we will handle that part. I already explained to you about those concepts. Now, as you can see, I'm going to go over demonstration problem number 3. Bodin commenced a consulting firm providing computer consultancies and had the following transactions during April 2020, the current year. And you can see first is April 1st invested 250,000 of his personal savings into a bank account opened in the name of the consulting firm. So we are given a list of transactions for the month of April, and the requirement is what you have to do is what is the transaction, and of course what are the accounts involved, and what is the nature of the account, and what is happening. This is the effect of increase and decrease, and you'll apply the rule of debit and credit. Now I would like you to work on this problem on your own, and then later on pause the video, work on it, and then you can come back and see the solution for it. So this is the solution for it. So you can pause the video and first try on your own, and then you pause the video and look at the solution. So that is demonstration problem number 3. So this is the problem and this is the solution. Okay, I'm moving on to the next. Now the next concept we'll have to talk about is a normal balance. What is a normal balance? Of course, the sum of the increase in an account is usually a greater or equal to the sum of the decrease in the account. So that is, supposing if I have a cash account and I have, let's say, 1,500 and 200 on the debit side, and let's say 200 and 100 on the credit side. The sum total on the debit side is 1,700 and this is a 300. So what does it mean? It means the account has a balance of 1,400. So that's on the debit side. You can see that I'm writing the amount on the debit side. That is 1,400. So now the normal balance of the account will have to be either a debit or a credit. But how do you know whether it's going to be a debit or credit? Remember, the increasing side is the normal balance. So remember this increasing side. For an asset, expense, and dividends or drawings, the debit is the increasing side. Therefore, the normal balance of those accounts will be a debit. And the liability, owner's equity, and the revenue, their normal balance will be credit, because that's the increasing side. So please remember that concept very, very clearly. So now what we are going to do is we are going to summarize the rule of debit and credit. Asset, expense, dividend, or drawings, they will be debited if they increase and will be credited if they decrease. Liability, owner's equity, and revenue, they will increase. If they increase, we'll credit it, but if they decrease, we'll debit it. And of course, you have to always think in terms of the business. So that is the summary of a rule of debit and credit. Now, what we're going to do is we're going to go on to the next concept for this segment of the video, that is journalizing. Using the rules of debit and credit, transactions are first entered in a record. Sometimes we call these record as a book of prime entry. Why we call that as a book of prime entry is because this is the first place that we are making a transaction, a record of a transaction. And the record as such is known as a journal, and the process is known as journalizing. And the entry you make in the journal is called a journal entry. So whenever somebody talks about journal entry, that means they're talking of the entry they are made in the journal in the process of journalizing. So that is, these are the three terms that we will be coming to it again and again. So now whenever you are journalizing, what you are going to do is you are going to follow the steps. So that is, of course, the steps that you're going to follow. Number one is you're going to write the date of the transaction entered in the date column. So that would mean if you have a journal, you will always have a page number of that journal. So let's say page 1. So the first thing is that you have a date column. So now that is the first step that you're going to do. Second step is the title of the account to be debited is recorded on the description column, and the amount is recorded in the amount column. So that would mean I will have a description column, I have a posting reference column, and I have a debit and a credit column. So these are the different columns that you will have in a journal. Okay. All right, so that is step number 2. Step number 1 was I put a date, supposing 2020, April, let's say 1st. That's the date. Then supposing if I have an account, let's say cash account, is debited with, let's say, $10,000. So that is the second step. The third step is the title of the account to be credited is listed below. And remember the word indented to the debited account title. So I'm going to indent it. So what is indent? Basically leaving a space. So I might start writing here, somewhere here, capital. This is some sort of accountants do. They have been doing for over several years now. Of course, it hasn't become. It has become a matter of practice. Why is as soon as you see this, I will know the first account is a debit account, it has been debited, and the second account is credited by looking at that indent. So that's how we know what account is debited and what account is credited at the look of it. And that 10,000, of course, is written in the credit column. So this was your step number 1. Step number 2 was this one. And step number 3 was this one. That is, you had a credit account. Then we do a brief description here. So that is your step number 4. So that is, let's say, owner's contribution to start the business. Now, in the present times, it has become redundant because we do a computerized accounting. So therefore, it's easier to track why this journal was made. So that's why we don't really enforce on it. But when you're talking of a journal, this is one part. So this is your narration. So number 4 is step number 4. Then step number 5, it says the posting reference column is left blank now, because I don't know where I'm going to take this cash account. Remember, we talked about the chart of accounts. So that is where it comes into play. Cash is an asset now. So I might open a cash account somewhere and transfer that 10,000. So if the page number of cash is, let's say, 101, after I post it, I will be writing 101, not now. So that is another video that we'll be working. So right now it will be left blank, but when the journal entry is transferred to a ledger that is known as posting, then we will be writing that page number of the ledger. So when I go to the ledger, I'm going to say journal page number 1 in the posting reference in the cash account. Here I'm going to say 101 depending upon the page number in which cash account is recorded. Okay, so that is these are your 5 steps. So let's just take an example of a transaction. On January 1st, 2020, Charles deposited 50,000 in an account for his new firm, Charles Law Incorporated, in exchange for 5,000 common stock of 10 par. So now this is just what we call information that you need to know. Common stock is always divided in terms of a par stock or a no par value stock. So anyway, we'll be always counting the number of the stock and then the value, so multiply that to get the total amount. So that's how we'll get that 5,000 times 10 will be 50,000. So sometimes they don't give you that 50,000, they'll just give you that 5,000 common stock of 10. You'll have to calculate and find out. So now you can see I have shown the several steps as well as the impact on accounting equation. So step number 1 was this transaction happened on January 1st. So I write January 1st in the date column. Then step number 2, I debited cash account with 50,000. So the debit account was cash and debit amount was 50,000. Common stock was credited. So that's how we have done step number 3. Step number 4, you can see a short narration which says issued common stock for cash. And in the accounting equation impact, you see cash account is increasing, therefore it is on the debit side. Common stock is increasing, it is on the credit side. Again, the following the rules of debit and credit. Cash is an asset, and if it is increasing, it's on the debit side. Equity, owner's equity is on the right hand side. If it increases, we put it on the credit. So that's why you see that effect. So That's your step number 1, 2, 3, 4, and 5 is the posting reference. I have not put the posting reference right now because I have not posted the transaction to the ledger. When we do the posting, I will show how it is done. Okay, that's transaction number 2. Transaction number 2, of course, on January 5, Charles Law paid 40,000 for the purchase of land. Two accounts, land and cash, of course. So land is an asset, cash is also an asset. Now land is increasing, that's why you see on the debit side of land, and cash is decreasing, therefore that's why you see on the credit side of the land. The amount is 40,000. Again, we have gone through the 5 steps. We're leaving step number 5 open right now. So step number 1, I wrote the date, January 5. Step number 2, debit account was land and credit account was cash, and I wrote the amount in the debit column and the credit column. I wrote a short narration, purchase land for cash. So that is how we handle your transaction number 2. Now, if you see transaction number 3, on January 10th, Charles Law purchased office supplies on account for 2,000. Again, office supplies is an asset. Now, here is the word again, on account. As soon as you see that on account word, it is a credit transaction. It will either result in accounts receivable or in accounts payable. In this case, it is going to be accounts payable because it is a liability, it is increasing, therefore you see on the credit side of accounts payable. Office supplies is an asset and it is increasing, that's why you see on the left hand side of the office supplies. The journal is office supplies account debit, accounts payable credit, and the narration is purchase supplies on account. So that is your transaction number 3. Transaction number 4, on January 18, Charles Law Incorporated received cash for legal services. Remember, the Charles Law Incorporated is a legal service provider, so therefore it has earned fees from its clients. So the two accounts involved are cash and fees earned. Cash is increasing and fees earned is also increasing. Now, of course, the impact, it should have been your fees earned, not accounts payable. Sorry about that typo. So please make that change. I will be doing that in my PowerPoint as well. Okay, so that is your transaction number 4. Transaction number 5 is on January 30, Charles Law Incorporated incurred the following expenses. So you have salaries expense, you have wages, rent, utilities, and miscellaneous. You don't have wages, salaries, rent, and utilities, and miscellaneous. So there are 4 expenses. All expenses are increasing as they are being incurred, and the date is January 30. So all expenses debited and cash is being credited with the total. That works out to be 7,000. And we write a short narration paid expenses. And you can see cash is decreasing. That's why it's on the credit side. All expenses are increasing. All expenses are on the debit side in the impact. So that is how we do the transaction number 5. Transaction number 6, of course, is on January 30, Charles Law Incorporated paid its creditors. Remember, we had purchased your supplies on account, so we are paying them off. So therefore, I will be using accounts payable because this is a creditor. If it is a customer, I would use accounts receivable. And now, since I'm paying accounts payable, it is decreasing, therefore I'm debiting it. Cash is decreasing and it is an asset, that's why it is credited. And then, of course, that is the impact on the accounting equation. Now, on January 30, Charles Law Incorporated took stock of the office supplies and established that it had 800 worth of supplies on hand. If you go back to your transaction 3, Charles Law purchased office supplies on account for 2,000. So we had office supplies of 2000, now it is worth only 800. Now what does it mean? It means I have used the 1200 worth of supply. So that is 2000 minus 800 would be 1200. So that is the journal that I'll be doing. Office supply expense would be debit and office supplies would be credit. That's how we'll handle this transaction number 7. Number 8, of course, Charles Law Incorporated paid dividends of 4,000 to Charles. Now Charles is the owner, so when you pay out the dividend is increasing again. So therefore, if it is increasing, you will be debiting it, and cash is decreasing, it will be credited. So that's how we did the journal and followed the same 5 steps in the process. So that will be your transaction number 8. Okay, now we've come to an end to this presentation. Let's just review. Question number 1 is a credit may signify a decrease in common stock, a decrease in assets, a decrease in liabilities, and a decrease in a revenue. So now remember, credit is whenever there is a decrease in asset, expense or dividend, that's a credit. So therefore it should be, if you decrease in asset, it should be a credit. Okay, now decrease in common stock, you can see it is a debit, so it's not A. And C is decrease in liabilities, again that's a debit. Decrease in revenue, again that's a debit, so that would mean the correct answer is number B. Decrease in asset would be a credit. Now number 2 is a debit may signify an increase in the common stock. So if you increase the common stock, it's a credit, so that's not the right answer. Decrease in the dividends account, so if there is a decrease in the dividend account, it is a credit, so it is not a debit. Decrease in a liability account, if there is a decrease in liability, it is a debit, so therefore it is going to be number C. So we'll be taking that. So question number 1 was B and this is C. So that's how we'll answer this question. Now let's move on to the journalizing. The process of initially recording a business transaction is called. That's a fairly easy question. It of course should be number B. That's journalizing. That's the book of prime entry, and that's the first place we make a record. Now question number 3, let's do the interpretation part of it. What is it? It says accounts payable is debit and cash is credit, paid creditors on account. So what effect does this journal entry have on the accounts? Accounts payable is a liability. So if it is debited, when will you debit? Of course, there will be a decrease. So whenever there is a liability decrease, so decrease in accounts payable and increase in cash. No, because it is a decrease in accounts payable, but it is also a decrease in cash, because cash is an asset and it should be credited. So therefore cash was credited, so that would mean number, which one? Number C, of course, because there is a decrease in accounts payable because it's debited, and decrease in cash, of course, and again it is credited. So that's why the correct answer would be number C. Okay, decrease in accounts payable and decrease in cash. Now, thank you very much for listening to the presentation. That's all that I have for today. So I'll be seeing you in the next